Most buyers in 2025 were overpaying by $8,000 to $15,000, and it wasn't because of purchase price. It was because of things that no one really talks about. So if you're out there and maybe you're just beginning this process and you're only shopping at rate and ignoring all these other things, you're literally leaving thousands of dollars on the table. And your lenders, they're probably not telling you this. By the way, I'm John Farrell. I've been lending for, it's a long time, since 2000, so almost 26 years. I've helped thousands of families get into their homes, and I've learned so many things the hard way. So I'm here to educate you so that maybe I could save you some time and agony. So in the next 10 minutes, I'll share information with you that can save you $5,000 to $15,000 on your next home purchase. And these are using 4 strategies you can use today. And you guys, this isn't like fluff stuff. It's real numbers and real strategies that you can use. Oh, by the way, if you want to get more educated on home buying, buying investment properties, or just education on homeownership in general, follow me for more. I'm doing my best to do this every week. It's stuff that lenders and real estate agents just don't teach you. So the 4 things we're going to talk about: smart mortgage strategy, seller credits, closing cost control, and real estate agent strategy. So at the workplace, you've probably experienced people that are buying or maybe refinancing, and everyone's obsessing about rate. Usually you hear in the by the water cooler, "Hey, I got a 6.5% rate. What did you get?" The other person, "I got 6.75. That person that got 6.5, everyone's like, "How did you get that?" Don't be fooled. Sometimes the lowest rate can cost you way more. And here's why. By the way, if you talk to more than that, you're going to get confused and usually taken advantage of. So 2 to 3 is the number I'd recommend, but you're going to want to engage in conversations with the loan officers and ask them, basically up front, first, share information. The most important part is know what your credit score is. All lenders are going to go off your middle credit score. So let's say we have a husband and wife, and the husband's got a 720, 719, 718 credit score. The wife, usually the ladies have better credit scores than us guys. It's kind of weird, but I get it. The wife has a 760, 755, and 745. The lender is going to go off the lower mid score of the 2 borrowers. So it's really good to know that, because credit score is a rate driver. And if you don't know roughly what your credit score is, it can bite you in the butt. All right, when you're shopping with lenders, maybe 2 to 3. If you go higher than that, usually more, you're going to get confused, and a lot of times you get taken advantage of. So I recommend 2 to 3, and you're going to want to speak with the lender, give them the particulars of what you're looking to do, and based on credit score, down payment, type of home, they can provide you some type of either a loan estimate. Some lenders can't do that, or some type of document to share with you roughly what their current rate is. And by the way, rates change daily. So when you're doing this, if you're talking to 2 or 3 lenders, do it on the same day. It's really important. Then once you get these loan estimates or these documents, you're going to want to compare them side by side. You might see one that has a lower rate, but it's got more cost. Well, probably because that lower rate is costing you to buy the rate down compared to maybe this higher rate over here that's costing you less, and therefore is going to allow you to have less cash to close. Initially, I would just get rough ideas. When you're choosing a lender, you're really going to want to know, have a conversation with them. Are they asking you more questions? Are they really engaging into you and getting to know you? And then from there, you're getting the warm fuzzies from them, and their rates pretty in line with everyone else. Then that's probably the lender you're going to want to go with, because once you do the application, you're actually going to be getting, if they're knowledgeable and they're experienced, they're going to be structuring and sharing with you different loan products, maybe different down payments, affordability, which is a really big thing, but things can kind of change. You're also going to be wanting to look at lender fees, or what we call origination fees. Now, every lender is going to have their lender fees. It could be like a processing fee, underwriting fee, whatever it is, but it all sums up into the origination fee. And that's really important, because when you're comparing and you're looking at rates, you can go, okay, well, this guy's got 6.5, this girl's got 6.625 in their originations. One has $2,000, the other one has $8,000. In the origination fees, which is going to be summed up with their whatever fees the lender is charging, there's going to be points where if you're buying down their rate to get a lower rate, they're going to have that there. Hopefully, if they're doing their job the right way and they're quoting you a lower than market rate. So you want to watch out for that. You're also going to want to review your total estimated cash to close. Now, this is going to give you a rough idea if they've really kind of gauged where third-party fees are going to be, your prepaids, which are your taxes and insurance, and your homeowners insurance. It'll give you a better idea of how much you might need down on this house. Now take it as a grain of salt because whatever they're giving you, it's not 100% accurate. And this is probably the most important. Look at when they're quoting you, how long is that rate locked? What I mean by that is a rate lock can be if they're locking your rate for a 10-day period or a 15-day period or a 30 or a 45. The longer the rate lock period or time, the more expensive the rate can be. But if you have a 30-day escrow, meaning when you get your offer accepted until the time you close, it's a 30-day escrow and they're quoting you a 10-day rate lock, well, that's no good. That's irrelevant. You want to make sure that whatever they're quoting you exceeds what your close of escrows or the time it's going to take to actually from when you go into contract on the home, get your offer accepted until the time you close. Paying points is a conversation we have a lot with our clients. Should we pay points? And again, should we pay an additional cost to get a lower than market rate? Or should we look at maybe taking a higher rate and getting a lender credit? It comes up a lot. This is really going to depend on the buyer, and what your situation is. I'm not a fan of paying points unless it's paid by the seller or maybe an agent credit. But if you're paying to get a small difference in rate down in a market where you may be refinancing later, you've got to really do the math and look at where the break-even point is. Okay, if I'm paying $5,000 to get a quarter lower in rate than a 0-point rate, but the savings between that 0-point rate and the $5,000 rate is 4 years, and a refinance opportunity can come up within that first 4 years, you probably don't want to pay points. It's probably a smart idea to stay away from that. So initially, I would recommend always asking for a 0-point rate. Now, the flip side of that is taking a higher rate and asking for lender credit. So when we're presenting scenarios or options to our clients, we're always presenting, okay, here's if you were to pay a point, here's a 0-point, and here's a higher rate with a lender credit, meaning the lender is giving the home buyer a credit for taking that higher rate. And why that can be an advantage is just because that credit then covers, or I shouldn't say covers, it helps reduce your closing cost and your amount due at closing. So if, let's say you're a first-time home buyer and you've been saving and you've got the 3% down, but you really don't have money for the closing costs. Well, this could be a great situation where initially you take a higher rate when you buy the home and it gets you into the home, and you've gotten a credit from the lender that helps offset your closing cost and it gets you into the home. The cool thing though is you're not always going to be tied to that higher rate. If a refinance opportunity comes down the road, whether it's 6 months or a year, you can actually refinance out of that and go into a lower rate. But initially you got that cash from the lender, that credit that gave the opportunity to get into the home. So let me give you an example. And I don't have my calculator in front of me, but let's just say that a 30-year fixed rate at 6.75% was going to give you a $5,000 lender credit versus a 6.5% rate that was 0 points, but there's no lender credit. So I'm going to use a simple number. Let's say that the difference in payment between the 6.5 and the 6.75% was $100. Well, a very simple math formula to figure out, okay, does it make sense to take the higher rate, get the $5,000 lender credit, is take the difference in payment, the $100, and the credit that you've gotten, divide the two and figure out where that number is. In this case, if it's $100 savings or increase in payment, but I'm getting $5,000, divide the two, it's 50 months. So the question would be, hey, if I was to refinance in the first 50 months, it probably makes sense to take the higher rate, get that $5,000 credit, reduce my cash to close, and have the opportunity to get in the home quicker. Another thing that's going to come up is there's various loan products. You've got FHA loans, VA loans, which are our government loan. VA is for veterans. FHA normally would be some type of first-time home buyer or maybe a borrower that lacks in credit scores. Maybe they have a lower credit score, so they're not going to get penalized like a conventional type of loan would. One other thing in 2026 that's going to come up a lot, I think it's going to come up a lot more than it did in 2025, is do I do a fixed rate mortgage or an ARM, an adjustable rate mortgage? And ARMs we're seeing have come down quite a bit more than 30-year fixed. And I think they're more prevalent now. I know they're more prevalent now. There's a lot more home buyers that are taking out ARMs. Now, full warning, you do not want to take out an adjustable rate mortgage because you want to qualify for a bigger home. That is not a smart idea. But if you are looking at options, you might talk to your loan officer and say, hey, can we look at fixed rate versus ARM? And then can you suggest to me the pros and cons on both? Every client is going to be different. And ARM can be a great vehicle, especially if it's a jumbo mortgage. Fixed rates, they stay fixed for 30 years. They're also safe, predictable, and in an environment where rates are trending up, maybe a fixed rate is a better option. An ARM, adjustable rate mortgage, is a lower rate that is fixed for a period of time. So let's say it's a 7-year ARM, meaning it's fixed for 7 years. At the end of the 7th year, it goes to an adjustable. In 2026, I'm going to say that 7-year ARMs are going to be a lot more prevalent because of how they are priced, and affordability has become such a challenge, I will say. But the risk is if you're not watching that ARM and you have no one managing your mortgage for you, and you kind of forget about it, and then you just wait for 7 years, then it goes to an adjustable. It can adjust up, it could adjust down. You want to have a better idea of what your initial few years is going to be. Are you planning on staying in this house for a short amount of time? Maybe you're not. Maybe you're like, we're going to be here for a long period of time, and we're going to be retiring in 3 years. Well, maybe an ARM is not the best way to go. So it's really important to have a conversation with your lender. But 2026, I will say many homeowners, many of us are betting that rates are going to be dropping. So an ARM can be a great vehicle to get a lower rate, lower payment until rates do come down. If they do, again, there's risk. But if they do, it can give you a little bit more cash flow, a little more breathing room. Section 2. All right, here's one of my favorite ones, seller credits and concessions. Why this is going to work in 2026? Well, let's look at 2021, 2020. You had a seller's market, multiple offers. If you even went in with an offer asking for any kind of repair or credit to help towards your closing costs, or frankly, even an offer matching the asking price, you probably didn't even get a response back. 2026 is going to be a great time, not only because probably a little bit more inventory is going to be popping up. There are going to be pockets where, and there are always pockets where maybe the buyer demand slows down a little bit and then picks back up. And it can drop on, it could be for a month, or it could be for 2 weeks, where there's that little small window where that house that normally would have 5, 10 offers on it, maybe it has 1 or 2. This is a good opportunity to come in when you're making an offer and ask for a seller credit, which is the seller giving you dollars to be used towards your closing cost, or to be used towards temporary rate buydowns or permanent rate buydowns. It's a good negotiating tactic. And I will say, I think in 2026, buyers are going to have some leverage again. All right. So again, what are seller credits again? So seller credits are where you've negotiated, whether it's through your offer, maybe after the home inspection, you've requested a certain dollar amount that the seller give you to reduce or cover a portion of your closing cost. It could be for temporary rate buydowns. It could be for permanent rate buydowns. These seller credits can be 3 to 6% of the purchase price, depending on the loan you're in. So think about it, a $500,000 loan, if you could ask for 6% seller credits, it's 30 grand. Now, you're not going to have 30 grand in closing costs. So you've got to figure out with your lender ways to utilize that full amount if that's what you're getting. But there's a lot of leverage that you can use to help when buying a home. When do you ask for these seller credits? All right, here's the best scenarios when to ask for these seller credits. If the home's been sitting for 45 to 60 days, meaning it's just been on the market, there's not as much buyer activity, it's a really good time to ask for it. Maybe you're seeing the price already reduced once, a stale listing, like 90 days plus, really good opportunity. Or that stale fish, I call it the stale fish, where the property's been listed for 90 days, there's nothing going on. It's a really good opportunity to ask for it. Another one is where the sellers, they're already in contract on another house and they've got pressure. They've got to move this home quickly. Your agent's going to probably know if that's happening. That's a really good time to ask for seller credits because they're motivated to move. They've got to act quick to get into that other home. And the biggest one is home inspections. When you've gone into contract, your real estate agent orders a home inspection report where a inspector goes in and they basically go through everything, plumbing, electrical, foundation, everything. No home's perfect. There's always things that come up, and this is a really good time to negotiate and ask for seller credit. And by the way, you have nothing to lose when asking. However, if you're going into a offer with 6 other offers, probably not the best time to do it. And you have nothing to lose by asking. But forewarning, if you're making an offer on a house, it's extremely competitive and there's multiple offers, it's probably not the best time to do it. When you're making that offer, you want to come in with a strong offer, and you don't want to have all these, I need you to do this, this, and this. The seller is going to basically look at your offer, and they got 5 other offers. None of them are asking for credits. It's not a good situation. Here's an example of 3 different situations that you can use or utilize to actually ask for a credit. Let's say you see a house and the asking price is $525. There's no offers on it. You offer $525, but in your offer, you ask for $8,000 in credits. It's probably a good time to do it, and you probably have a good shot at getting it done because the seller has seen their asking price and it feeds into their ego. They're like, okay, this buyer, they've met my price and asking for that $8,000. Wait, let me do this again. Here's 3 different scenarios that you can negotiate seller credits, and it would be a wise thing to do. Let's say you see a house and it's listed at $525. You make an offer at $525, but in your offer, your real estate agent asked for $8,000 in seller credits. If there's not other offers on there, the seller is probably going to be more motivated to do that than if you come in at $500,000. You see, the seller sees their list price. It's kind of an ego win. And you get $8,000 back at closing, and the net to seller is $517,000, which is better than if you planned on coming in at an offer price of $500,000. Number 2, and the most successful way of getting credits, is post-inspection negotiation. This is a win that happens most of the time. Hey, Mr. Seller, we found $12,000 in roof repairs. We're not going to ask you to do the repairs yourself, but we would like $12,000 in credits so that we can do so after. And why this works is this is important. The seller, they could go off and get some shoddy roof repair person that's going to do a shoddy job. If you're getting those monies, it's going to reduce your cash to closing, the money that you were planning on bringing in. You're $12,000 less to bring it in. You can go get bids. Now, maybe it's not going to be $12,000. Maybe it's going to be $9,000 to do the fixes, but you can control who's doing the work to make sure they're doing a good job. And the third biggest way for seller credits, and this is the one we love, is, hey, Mr. Seller, I'm going to offer $550,000 asking price, but I need $12,000 in closing cost credits. Meaning I need $12,000 from you. And what is that going to be used for? That's going to be used for either helping you with your closing costs, reducing your cash to close, or maybe you look at a permanent or a temporary rate buy down. That's a whole different video, but this is a great way to actually get a initial lower payment with lower cash due at closing. All right, mistakes to avoid. This is a big one. If the asking price is $550 and that $550 is a fair price, win for the seller, win for the buyer. And you go in and say, hey, I want to do it for $510. So you go in, we're going to offer you $510 and I want $15,000 in credits. You're probably going to piss the seller off and not even have a chance to negotiate and not even have your offer looked at. So avoid that. Don't over ask in hot markets. If there's a home or, your agent's going to give you an idea what the market's doing because the market's changing all the time. If you have a hot market, there's multiple offers, it's probably not the best time to ask for seller credits. You can ask for it. If you get your offer accepted, you go to negotiation during the home inspection, but up front, I would avoid it. Now, granted, if there's no offers on the house, it doesn't hurt. And don't forget to clear it with your lender first. Your lender should be communicating with you too, first and foremost. But if you're planning on going this approach, make sure you're having the conversation. Section 3, closing costs you can control. Total closing costs is somewhere between $11,000, $24,000. And of course, it can go higher than that and it could be lower. It just depends on the area you're in. So here's what you can control. Origination fees. Every lender is going to have their origination fees, as I shared earlier. This one you've got control over. If there's a buttload of origination fees and they've got all these points, well, a way to reduce that is look at a different rate or a different product. But you do have control over this. This is the one thing. If you don't like what lender A has because they've got all these origination fees and points and all that, and lender B doesn't, and their rates are slightly higher, then you can call lender B and go, hey, I'm looking at this over here. Can you help me understand it? Or lender A, hey, I'm looking at lender B's. Can you help me understand why you're so much more? You've got negotiating power on this. And your potential savings, it could range. I mean, it could be $2,000. I've seen tens of thousands of dollars. Title insurance and escrow companies. This one, you can control it. I will say on most purchases and title insurance and escrow fees. Now, I don't want to get in the weeds on what these are. yes, you have ways to control it. They're all regulated, and so they're going to be pretty darn close. Most of the time when you're buying a house, the title and escrow is going to be chosen by the listing agent. You do have the ability to choose your own, but you've got to make that in your offer. So you've got to have your agent request that you're going to be using your title and escrow contact. Homeowners insurance, this is a big one. Now, homeowners insurance, I recommend you speak to 2 to 3 different insurance brokers. I'm here in Southern California. Since the LA fires, things have changed drastically. But the things you want to watch out for, don't just go for the lowest insurance provider, because their coverages, they can tweak it, and their coverages can be below what it costs to replace the home to what its current status is. Meaning that the lender is going to make sure that if the house burns down, that they've got the replacement cost. But it could be like, if you've got a pretty nice house and they'll replace the house, but it's not going to be to the same like as the structure it is now, you've got to watch out for that. So you really want to work with a knowledgeable homeowners insurance broker or, big firm, whoever it is, but ask questions, because that's really important. But you can save money there for sure. And there's a couple areas you can save money too. So there's optional add-ons, home warranties. Home warranties are most of the time paid by the seller. It's negotiated in. I'm not a fan of home warranties. I think they're complete con. I've had multiple home warranties. Every time I've called, they come up with a reason why it's not covered for the stupidest reason. So truthfully, I mean, if you're getting into home ownership, maybe you get a home warranty. You'll probably think the same way I do later on, that it's a waste. When you're buying a house that has a pool, the home inspector is not a pool inspector. So you would want to order your own pool inspection. I highly recommend that, because it doesn't cost that much. And if the pool has major issues, it'll cost you a lot more down the road. So if you have a pool, order a pool inspection. You'll save thousands potentially. Section 4, discount agents, when it works, when it doesn't. The 2026 commission landscape has completely changed. So buyer's agent compensation is 100% transparent now. And this is where you have negotiation. And more importantly, I'm seeing more negotiating happening. Some is warranted, some I don't think is. And the biggest thing that I'm noticing is there's a lot more discount brokerages popping up. Save this amount of commission, 1.5%, 1%. There's just so much noise out there. So let me just explain, give you a quick example of how commission works. So the standard has always been 3% on buyer agent, listing agent, 3%. So if you're buying a $500,000 house, each agent is roughly making $15,000. And if you negotiate to 2%, that's $5,000 off. So it kind of sounds good, right? But here's the hidden cost. Number one, probably the most important, is negotiation skill. I'm seeing discount brokerages or agents that have no negotiation whatsoever, and it's costing these buyers that are using them a lot more money than they're saving. Let's say you save $5,000 on commission, but you've lost $20,000 in a negotiated price. I mean, you get a weak negotiator, and usually this is discount real estate agents. You are usually overpaying for a home, or they have not negotiated once you're in contract on the inspection or things that come up that really good agents know what to look for. You also lose out on time and attention, and frankly, communication. Home buying is one of the most anxiety-driven things that we go through. And one of the keys to keeping those anxiety levels down as a buyer is actually having fluent communication that's good, where you can actually call your agent and talk to them. An agent that's making, I'm just going to say it, an agent that's making more is going to be a better agent, and they're a better agent because of their communication, their negotiation skills, and all that. So you really want to watch out for it. Now, granted, if you're just looking for, hey, I just need someone to get me into the house, maybe you use a discounted agent. A good agent also has a lot more market knowledge. They know what's going on in the market, and the market cycles change drastically. So maybe there's a better opportunity to get in at this price point than a month ago. Or there's pocket listings, and they know about those. Pocket listings are homes that aren't listed on the MLS, and publicly we can't see them. There might be a really good gem that fits your needs that you would never even see it, but that agent knows about it. Discount agents, they're not going to know this stuff. So pricing strategy is going to be really important. Usually if you're paying more for a knowledgeable, experienced agent, they're going to know how to price that strategy and get the offer accepted. I will share one other thing. I've seen this a lot. You've got discounted agents that, come into an area and they're making an offer and you're competing against two other agents that have a lot of experience. They're well known in that area. That listing agent is going to be more inclined at looking at those offers than this agent that is a discount. And last, they're going to prioritize you a lot more than a discounted agent. Maybe the discounted agent's got 10, clients, whether they're getting leads online or whatever they're doing. They're working for one of the discounted brokerages and it's just a numbers transactional game. The agents that are experienced that charge a premium or, they charge for what the value is that they're giving you, they're going to be more hands-on, a lot more focused on your needs. So let me counteract that. When a discount agent makes sense, maybe like you're an experienced home buyer, the area, maybe it's a home that you have a connection with the seller and you just need someone to write the paperwork. Maybe you do consider that discount agent because all they're going to do is the paperwork. You don't need all the knowledge and all that stuff, and that works. Or maybe you're looking at new construction and there's not going to be as much negotiation. So you just, you need an agent acting on your behalf. Maybe then you consider a discount agent. But the bad scenario is to use a discount agent. You need hand holding. Maybe there's a market that you don't know enough of, but that agent is really good in that market. You want to shy away from that. So how do you interview any agent? Here's some questions you'll want to ask. What's your average list to sale ratio? Good agents, they're like 95 to 100%, which means that they get close to asking price. Weak agents, they might be 70. They could be 60% to 75. That 5% difference, let's say you're selling your home for $500,000, that's $25,000. Another really good one is show me 3 recent deals where you really negotiated hard for the buyer. Examples would be like, well, there's a deal that we just closed where we got $20,000 in seller credits that the buyer wasn't even expecting. Or maybe it's this home inspection report came in really bad and here's how we structured it and we got credits or a reduction in sales price based on this inspection. Another one is how many active clients do you have? Or maybe how many listings have you sold in the last 12 months? This is really going to show their experience. Is it a hobby agent where they did, one transaction in the last 24 months? If they did that, you probably want to stay away. They don't have as much experience. Another one is, do you have any off-market or pre-market access? Many good agents will know. And these deals, they really don't have as much competition normally. All right, quick recap. If you're a buyer, shop with 2 to 3 different lenders. It's really important. You're going to get an idea of who you like more, who's got a competitive rate, who's educated you on different loan products, different strategies, whether, they've got experience on getting seller credits for temporary rate buydowns or for closing costs. Or does that loan officer actually, when you're making offers, do they call the listing agent to really ensure to the listing agent that you're well qualified? We've been doing that for a long time. That has been key, especially since COVID. That has been one of our biggest wins, is that a lot of the times if there's 5 offers and we're the only lender calling the listing agent, they're more inclined to take our buyer's offer than the other ones where the lender didn't even call. 2, ask for seller credits. You're going to know when to ask for them when working with a good agent or a loan officer. But in 2026, I think that's going to be a big one. And I think there's a lot of opportunity. 3, control what you can on closing costs. You've got power here. You can save thousands of dollars. It just takes a little education to know what to look for and what you can negotiate on. And 4, be strategic on your agent choice. Discount agents, they can backfire. As you can tell, I'm not a huge fan of them. Even when I'm buying and selling my own homes, I'm not using a discount agent. In fact, I'm paying a premium to have the best agent because I know they're going to get me top dollar for the house that I'm selling. So I guess that focuses on pay for skill versus lowest commission. One favor again, if you like this video and you got some value out of it, if you would like it and subscribe, I'd really appreciate it.